This is the third video on Berkshire Hathaway, and today we'll talk about the intrinsic value of the company. As we saw before, Berkshire has multiple business lines as well as insurance business which has different accounting standard compared to normal businesses. So in general, it's pretty difficult to calculate the intrinsic value of Berkshire Hathaway. One way Buffett suggested in 2018 is dividing the company into 5 different parts and evaluating each one. But even Buffett himself suggested various methods to value this company. So today we will gonna use both top-down as well as bottom-up valuation methods to get a good estimate of the intrinsic value. So let's start with the easy one, which is price to book value. Normally, for a typical insurance company, PB ratio is pretty good estimate of the value because its assets are mostly formed with financial assets which are marked to market, as well as its liabilities which are also marked to the market. So in case of Berkshire, Buffett suggested in 2011 that 1.1 times of book value is appropriate for the company. So he would buy back if the price falls to 1.1 times. However, he increased the standard in 2012 to 1.2 times of the book value. And in 2014, the PB ratio of Berkshire increased up to 2 times, and Buffett suggested that this is unusually high. And he reaffirmed his 1.2 times buyback threshold in 2016. So from these comments, we can see that Berkshire's intrinsic value is somewhere between 1.2 to 2 times of book value. In 2018, Buffett said he would buy back Berkshire whenever the price is below intrinsic value. And in 2020 to 22, he actually bought back shares near 1.44 times of the book value, as well as in 2024, where he bought back shares between 1.4 to 1.5 times. So from these comments as well as actions, we can see that Berkshire's intrinsic value can be considered cheap if it's traded between 1.4 to 5 times. However, there's an additional factor that we need to consider. That is, the appropriate PBR for Berkshire would go up in the future. And there are several reasons for this. First is the operating business. Because Berkshire is not a typical insurance company, it doesn't invest in marketable bonds and securities only. Instead, as we saw before, Buffett collected large businesses over the years through M&A activities. And because these companies have high intrinsic value, which would not be captured well in the GAAP accounting system. So as a result, Berkshire would have higher PBR ratio than typical insurance companies. Second factor is float. Usually, insurance companies reflect float as a liability on its balance sheet. However, in Berkshire's case, these floats are cost-free, and in fact, they generate some level of profit for the company. So based on these facts, Buffett said such profitable float is one of the reasons why Berkshire's intrinsic value substantially exceeds book value. And because the float continues to increase for Berkshire, we can imply that the appropriate PBR with Berkshire would go up in the future. And third reason is buybacks. So there are two facts that you need to consider, which are basic mathematics of buybacks. First is that if you buy back shares below intrinsic value, it increases the intrinsic value per share. And second fact is, if the buybacks are above book value, then it also decreases book value per share. And for Berkshire case, these two factors are both true, because the management would only buy back below intrinsic value, and as we saw before, Berkshire would trade above book value in normal cases. So combining these facts, we can see why Berkshire's PBR should go up in the future if there are buybacks conducted by the management. And fourth factor is DTL, which is deferred tax liabilities. In Berkshire's case, this is created when the company buys shares and its value increases. For example, Berkshire invested in Coca-Cola decades ago. However, it did not sell any stocks yet. So on its book, the company recognizes that if the company sells those Coca-Cola shares, the amount of tax that it has to pay to the US government. However, because Berkshire invests long term, it doesn't actually have to pay these taxes until it sells those Coca-Cola shares. So if you calculate the present value of this liability, it's typically less than its book value amount. So for a company like Berkshire, where they invest in long term, DTL is another factor that increases its appropriate PBR. So considering these factors, let's look at the actual trading data of Berkshire over the decades. As you can see here, it traded between about 1.2 to 2 times, and Buffett bought back shares during this 3 to 5 year period, where stock traded between 1.1 to 1.5, and currently it sits at 1.6 times of book value. So we can see that it's not extremely cheap nor very expensive, but it's definitely below the 2 times overvalue that Buffett suggested. Moving on to the next factor, it is the P/E ratio of normalized earnings. This is suggested by Munger that for companies like Berkshire, appropriate multiples would be between 15 to 20 times. And if we look at the EPS, we can see that it's on an increasing trend. However, there are various fluctuations where EPS decreases significantly, and that's why we need to adjust the earnings to normalize it. And after some modification, if you look at the P/E ratio, it traded very highly during the IT bubble. But if we zoom in the past 20 years, we can see that it trades about 10 to 21 times. So if we apply the Munger's 15 to 20 times, we can see that it's a good opportunity to buy if Berkshire trades between 10 to 15 times. And third valuation method is two-pronged approach. This method comes from Buffett himself. So he basically says we should capitalize the pre-tax earnings at reasonable multiple and then add the value of securities that Berkshire holds. This looks very simple, but if you get into it, there are some complicated details. For example, what should be the reasonable multiple of the pre-tax earnings? Also, what about the insurance underwriting income, which fluctuates a lot as we saw before? For instance, Buffett himself added this insurance underwriting profit in some years in the past, but in other times he suggested that we should ignore it. And on top of this, we should make additional adjustments, such as excluding dividends, interest, and realized capital gains and losses from marketable securities. And there is a public data on this two-pronged approach, which is conducted by Chris Bloomstern, a well-known value investor. So as we can see here on the left side, there are pre-tax earnings multiplied by appropriate multiples, and in the middle, the value of marketable securities, and on the right, he separated out the underwriting profit, so he can add those or ignore those as he sees fit. We will lay out each of these valuation results in the end. So now let's move on to the fourth valuation method, which is SOTP. This method divides Berkshire into various parts and calculate value of each segment. And for each segment, it needs to conduct the following valuation activities. And on top of these, Berkshire changes its reporting standard every now and then, so we need to make adjustments as those reporting changes happen. The easiest segment to value would be BNSF, because it's a clear, separate business and Berkshire reports its pre-tax earnings separately. So we can apply the railroad multiples of traded companies and calculate the value of this segment. But we need to do this to other business segments as well, and this is a result that I have done. And on the right-hand side, you can see the proportion of value applied to each of these segments. And this is very helpful because, for instance, in equities, the stock portfolio only contributes about 20% of Berkshire's value. So even if the portfolio falls by 50%, which would be a rare case, the total decrease in company value would be about 10%. And we need to make such calculation for other segments. For example, if there are good or bad news in terms of electric utility business, we need to adjust these valuations as those news come out. And the fifth method would be free cash flow, which can be also called GAAP adjusted financials. This is because we start from the GAAP accounting earnings and we adjust to get the free cash flow numbers. And there are various adjustments that you have to do. For example, here I laid out A, B, C, and D slides. So if you're interested, you can stop the video and read each of these and also apply this adjustment to Berkshire. However, these adjustments are also quite subjective. For example, if you can see here, we need to consider the hundreds of billions of dollars of cash pile that Berkshire sits on. Currently, it's only earning about 4.5% by investing in short-term US treasuries. However, the reason why the management holds that in cash instead of investing in S&P 500 is because they expect to earn higher earnings when good opportunities arise. So we can see they can be quite tricky to reflect this value into our valuation methods. So we've looked at several ways to value Berkshire, and now let's talk about how we can invest in Berkshire. And since I'm going to talk about investing in a company, I just want to mention that this is not an investment advice, and you need to make your independent decision when you make investments. If you want to see how I invest in companies like Berkshire, you can click the link below and look at service where I provide model portfolio with clear buy-sell signals. Going back to the slides, today I'm going to talk about two methods to invest in Berkshire. First is considering the company as just a value stock. So if the company becomes cheap, we can buy, and if it becomes expensive, we can sell. But obviously, the difficult part is how to know which price is cheap or expensive. The first signal would be buybacks. Because Berkshire does not do constant buybacks, when the company does buybacks, it's a clear signal that the management thinks the company is cheap. So we can track this every quarter and see what the management thinks about the market price. Second is conducting the valuation that I mentioned today. So if I aggregate those results, we can see here that Berkshire's intrinsic value is between $450 to $517 per share. So we can buy Berkshire more confidently if the stock price falls to above $450. But if it goes above $520, then we can stop buying or start consider selling. But instead of stopping here, we can also quantify the undervaluation, which means we can calculate the intrinsic value of the past decade and then see how much upside there were in the past. So we can see here in the purple part, when the management conducted buybacks, the upside to intrinsic value was between 40 to 60%. But currently, the upside is less than 20%. So depending on this, we can get a feel for how cheap Berkshire is at the current price. And let's look at the actual Berkshire stock price to see how we can apply this. So in the beginning of the year, Berkshire traded at about $440, and around April, it traded around $540. So if we had this valuation table, we could easily buy at $440 per share. Also, we would have considered selling a little bit when the stock reached above $540 because it's way above its intrinsic value. So this is the first method, considering Berkshire as a value stock. And second method would be consider Berkshire like an index fund investing, similar to S&P 500. In our first video, we calculated the historical performance, but when we make investment decision, we need to look forward. However, since future is uncertain, we are going to apply scenario analysis here. And we're going to start with what Buffett has said. He said that book value is not a perfect measure, but its growth rate can be a proxy for long-term growth rate that Berkshire can reach. So based on this, I calculated the book value growth rate of Berkshire. And based on 5 to 10 year rolling CAGR, Berkshire's growth rate has been about 11 to 13%. So going forward, we can assume that 13% can be our bull case and 11% can be our base case. And for S&P 500, I'm going to look at the past 10-year performance, which included the COVID period as well as interest rate increase in 2022. And S&P generated 12.9% per year over the 10 years. But if we zoom in to past 5 years, its performance has been higher at 14.3% per year. And since AI is the dominant story of the market, if we zoom in further and start the performance from November 30th of 2022 when ChatGPT was launched, S&P 500 generated 18.7% per year, which is the highest. So going forward, in the bull case, we can assume that the AI hype would go on for several years. And in the base case, we can look at the historical 10-year performance as our expected going forward return. And for bear case, I'm going to go back to the table that we saw before, where I assumed that S&P and Berkshire would fall to its long-term average multiples. So S&P could fall 59% and Berkshire could fall 11%. And we can lay out these numbers into a table. For example, these are 3 expected returns for S&P 500 and Berkshire in bull-based bear case. And here we can apply probability. For example, the bull case where AI would continue to dominate the market story, S&P would increase 18.7% and Berkshire 13%. And we can apply 25% probability here. And for the base case, we apply 50%, so the bear case would be 25% probability. And if we apply these numbers, we can get the weighted average expected return. And here we can see that in these scenarios, Berkshire would definitely outperform S&P 500. But obviously, we can change this probability and then see how the expected return changes. And here, Berkshire also would outperform S&P 500. Then you might ask, in which case S&P would outperform Berkshire or generate same return as Berkshire? So we can calculate a scenario where both would generate about 9% return, and that is, bull case would have to get 50%, and base case 40%, and the bear scenario would have to be very unlikely at about 10%. So this can be also pretty reasonable scenario, depending on how you look at the market going forward. And with this table, we can make a numbers-based decision when we decide to invest in whether Berkshire or S&P 500 or both of them at different proportion. So today we talked about intrinsic value of Berkshire and opened the discussion on how to invest in Berkshire. And our next, fourth video will be on major risks of Berkshire Hathaway, as well as additional investment strategies that normal investors can consider and benefit from Berkshire Hathaway.